No
Thank
issues
you.
here.
All right, perfect. All right, well, let's just go jump right in then. I'm going to go ahead and share my screen to start to give you guys a kind of a good little rate update, let you know kind of what's going on in rates. So let me go ahead and share my screen real fast. And all right, so now you should be looking at this alert to lock page that just posted. And basically today we have lost 28 basis points since opening. So that's a pretty big adjustment for an early morning. And there really wasn't a ton of activity going on right now, other than the fact that there was the JOLTS jobs report, which states how many new openings are available, came in at the highest that it's ever been. So new job openings, there's 10 million job openings that were posted for the month of June. So as far as job availability, it's there. There's just the labor force right now is either not wanting these jobs or they're not wanting to work, one of the two. So, but that's good news for the economy as far as companies wanting to hire. And that means that there's money to spend. That means that there's potential growth in companies. So that's always a positive thing for the economy, which if you've heard my updates, often the inverse is correct with mortgages. If it's good economy, usually rates are bad. So when there's a really good economy, rates get higher. That's basically the correlation there. Now, if we look to see kind of what the markets are doing, let's do a deep dive, because last week we were showing really a great trend, and we were looking at this and we were seeing this trend here. Let me just see if I can. Oh, it's not working for me. There we go. It's slow. Here we go. This trend upward right here. This was a pretty long trend from June 14th to, well, till this Friday. And then this week has been a just drastic decline. So the reason for that was the jobs numbers came out and 980,000 people went back to work. So it was almost 1 million new jobs that were posted for this period. So that is a significant boost to the unemployment numbers. So if you look at the unemployment numbers, the rates, right now we're at the 5.4% right here. This spike that you see was, I mean, we got all the way up to almost 15% unemployment. This was the COVID spike. And this shows you the recessions over the years and the unemployment numbers that we hit. So 2008, it was about 10% unemployment at the peak. And we jumped way past that in March of last year when COVID kind of shut down everything. But we've gained it back very quickly. The V curve that everyone talked about, that's what it is, a V curve. That's straight up and straight down in a V. That is a very quick recovery. Now, it's not economically based, so that's why it's such a quick recovery. Everyone just is going back to work now. So that's a good thing. But that's bad for interest rates. Here's another look at the participation rate versus employment rate. This huge drop down, and then it's coming back to normal. So this is going to be interesting to watch, kind of how unemployment kicks up. And then here's another really good graph. This is pretty interesting. This is the 2007 employment recession. This blue one right here, when the real estate kind of crashed. Look how long it took to recover. Now look how fast this is recovering here. And that fast recovery is a really good thing for the economy. But like I said, as the economy gets better, rates get worse. And that's why we're seeing this decline right now in the bond market. So what does that equate to in rates? Not a ton. This is about, oh, let's see, 102.2, 101.4. It's about 80 basis points in change. So what does that mean? That means basically a rate that cost 0 points last week
Outside, you guys.
now costs 0.8 points to get.
Outside.
So so it's a it's not a huge change, but let's look to see what the national averages are now. So we were at 2.8 last week. Now the national average is 2.9 on a standard 30-year fixed. So still really good, but I am a little worried. Now, see this little spot where we stopped right here? Let me delete these because it's getting a little confusing. This little spot that we stopped, that's what I call well, that's the 50-day moving average. It's a floor, it's a ceiling, it's a floor of resistance. We bounced right on that. And what I'm worried about is more of the 10-year. So if you look at the 10-year, we still have room to move. So we broke through 3 layers of resistance. We were down here, it came up and it stopped right at all these levels of resistance. There was a triple layer. That's hard to break through. Well, today it broke through that. So now there's another 8 basis points that we could lose in the 10-year. I say lose, it's actually gained on the 10-year, but that would put pressure on rates to go higher as well. So there's still room to get worse. So the alert to lock came out this morning. I locked in probably 3 or 4 loans already this morning before the rate change happened. And then about 15 minutes after I finished locking, the rates got worse, and they were all posted as worse by about 23 basis points, which is the difference of this morning. So in a nutshell, we saw a little bump in the road. It's still really good. The rates are still very good. This week we have inflation numbers that are going to be coming out. So we'll see what that looks like. We may have a little bit of a reversal if they look really light. So this could be maybe just a short-term event. So now that's a little rate update. Any questions on what's going on with rates? Don't be shy if you have them. All right, perfect. All right, I'm going to jump right into, so in the real estate market, agents, it's important to know kind of what the different mortgage products are out there and kind of how they would be applied to specific buyers that you may have. Now, you don't want to get too deep in the weeds with knowing these products, but you should know just the basics. So what I put together is kind of what you need to know on the different loan programs that are available to help you when you are trying to market, or if you have past customers that you've talked to, that you may say, wait a minute, that sounds like it may fit for this type of a loan. Now, you don't need to get into the weeds when I say that. There's so many more guidelines that are to these that that's where you just kind of use it to try to isolate maybe some opportunities, but then you utilize me for all of the details surrounding it. Let me just turn this on mute real fast. All right, so FHA, I don't know if you know this, but FHA has a lot of different options. The 203B is a standard FHA loan. That's 3.5% down. We don't have any credit score requirements. The mortgage is permanent. So once you have the monthly mortgage insurance, it does not go away no matter how much equity you have unless you refinance. And there's a mortgage insurance premium of 1.75% of the loan amount that's rolled into the loan. So a little expensive, but it has a really high DTI limit of 55. So the risk-based, a lot more riskier loan because you can, for the lender, because the borrower can afford more and have a bigger mortgage based on their income. The only thing I want to point out with FHA is the flip rule. This last 2 years, we've seen a lot of flips. And if you have an FHA listing and the property was, or a listing that you want to put FHA as the financing on, make sure you know that if it's a flip, that it's been 90 days since the transfer of title. But that's the only real piece of the puzzle you need to know about the FHA. The rehab loans too, if you have ugly properties that are in the FHA limits, you may want to put in the comments that a 203K loan may be suitable for the purchase of this property, so that first-time home buyers won't shy away from that type of maybe a property that needs, I don't know, a new roof, or a property that needs walls moved or painted or flooring or appliances, you name it. That 203K rehab loan is a perfect tool for that. And on that, you can borrow up to 110% of the property's future value, or the home price plus the repair costs, whichever is less. So you can, it's pretty aggressive. And then also on FHA, don't forget the tribal home loans. It's only 2.25% down for those areas that are on Indian land. It's a great tool for them as well. And then here's the limits. So as you can see, depending on the county, like Maricopa County, Phoenix Mesa is 368,000. You get into Prescott, you're at 356. You go up to Flagstaff, you're at the 389. So FHA limits are different depending on your county. So just be aware of that. Now conventional is a little different. Conventional does have an income or a credit score hard stop at 620. No lender in the United States can go lower than 620 on a conventional loan. That's the absolute limit. Now, some lenders have overlays that say that they can only go down to 640, but the real law, the real rule is 620. Also, the debt to income ratio is 50 as the max. And I want to go over to mortgage insurance because everyone thinks that you have to do 20% down to remove mortgage insurance or to get away from the monthly mortgage insurance. And that's not the case. Mortgage insurance gets cheaper the more you put down. So if you wanted to put 15% down and have no mortgage insurance, it's possible. You can do what's called lender paid mortgage insurance, and it may be just an eighth higher in rate, and there wouldn't be any mortgage insurance, and that payment may be much cheaper overall. So if you have people that are afraid or think they don't want to buy because they don't want a loan with mortgage insurance, they want to save up for 20% down, let them know there's options to not have mortgage insurance. And you can even buy it out too. And there's some strategies that we can go over on that. Also, we do 80-10-10s, first and a second, to avoid mortgage insurance. We're doing those quite a bit now. And conventional also has rehab loans. So don't forget about that. And there's no flip rules at all with conventional loans. Loan limits, you might, well, 548, 250 is the Arizona limit. And then if you do 2 units, it's up to 702, 3 units goes higher, 4 units up to $1 million. So a lot of people don't know how high you can go on conventional loans with multi-units. So that's a good representation of that. Now, VA loans, one of my favorite loans ever, they don't have any limits. You can do 0% down up to $1.5 million if you wanted to. The only expensive part is the VA funding fee. So depending on whether or not you've used your VA eligibility before, would determine what that it could be, and it could be up to 3.3% of the loan amount, so quite high. But there's no monthly mortgage insurance, and it's 100% financing. Also, there's no debt to income ratio requirements on VA loans. So I've had people make $2,000 a month have a $1,500 payment, and it works. It really just depends on what their residual income is for that household. And it's a different type of a risk-based underwriting assessment, but it's a really great loan. But no FICO score requirements for VA either. Now, some banks have overlays, some mortgage companies have overlays, but we do not. But they can create their own rules to be less or more risky if they want. Jumbo, anything over 548, 250 is the jumbo world. Usually 10% down is the minimum you can do. So make sure you guys know that if you have jumbo customers. All jumbo lenders or loans are investor specific. So there's not one national guideline for jumbo. Every single lender, including us, has a different sets of rules for what we are willing to take on a jumbo loan, because those are not guaranteed by any government entity. They are guaranteed by the balance of the balance sheet of that mortgage company. So it's a portfolio loan. They are all portfolio loans, and they all have different guidelines. So it's a little tricky when customers come to us with really unique circumstances, because we need to go through all the different guidelines. That's why jumbo can be a little tricky for a lot of people, but we've got some really great options for that. And then non-QM, anything that's not traditional jumbo or doesn't fit any of the boxes with what the government has for regulations for what they call the ability to repay laws, falls under the non-qualified mortgage. This is all of the bank statement loans. This is all of the stated income loans. This is all the no-doc loans, like true no-doc. Like, I work here. I'm not going to tell you what I make, but here's my credit score. This is my job. I want a loan. We have those right now. They require 20% down or more, but we have them. So a lot of really good no-doc, but they're not guaranteed by any entity. So they're higher risk. Rates are a little higher, but they work. And then home equity lines, those are basically a checkbook on your home. It's a banking product actually. So that is not a Fannie Freddie type conventional loan. It is a private portfolio loan issued by banks, and they're free. Anyone can get a home equity line at any time. If you have a lot of equity in your house, I actually highly recommend you get a home equity line and not use it. The reason I recommend this, in real estate, you're going to run into deals every once in a while, and you're going to say, I wish I had some cash to buy this house right now and flip it or do whatever. You can get a home equity line and not use it, and it just sits there with no payments for however long you have it. And then if you run into an opportunity, you can write a check for it. So it's a great way to take advantage of opportunities if they come your way. That's why I say great for tool flipping. Yes.
Can I ask you a quick question? What are there any costs in setting up that home equity line of credit?
Usually they're free.
Okay.
Usually the appraisal and everything is paid for by the bank. I traditionally go to BMO Harris for all of my, and I've got some really good contacts over there for my home equity lines because they have really good introductory rates of 1.99 for 6 months. But it's a great tool and there's no cost for it.
Okay.
And then there's a lot of different grants. Each one is different. Each one is specific to the needs of each individual person, but there's a lot of different grant programs that are out there. Chenoa goes all the way down to 600 credit score now. And then these others require higher credit scores, 620, 640, and 660. So depending on what people need, those are the options. So really, those are the only loan products that we have as lenders. There's not a ton of them, but the guidelines and the rules for each are very, very unique. So we need to make sure that we vet them properly and do the proper pre-approvals. But I want to go into more property specific. So with condos, conventional loans, they have to go through a separate approval process side by side with the borrower to make sure that that property is an approvable property to match and meet the guidelines for condos. So a lot of times you'll get in a transaction and then 3 weeks into it, the condo is not approved. That happens, and it can happen frequently if you don't order that condo questionnaire or that condo approval early in the process. So all mortgages must go through some sort of an approval process when you get a condo. FHA, they have to already have been approved in FHA system. The same with VA. So they have to be in the system approved through VA in order to do a VA mortgage on that condo. This is very important when you have listings. If you have a condo listing, make sure you're looking it up on the VA and FHA website to see if it's an approvable condo or not. If it's not, it may fall under this non-warrantable condo, which is a very flexible loan program. It's a non-qualified mortgage, so it fits under that bucket above. And usually it's 20% down or more for those products. But they don't care about things like occupancy ratios or if one person owns a certain percentage or more of the entire complex, or if there's maybe a lawsuit in there that isn't that's being remedied, and there's all kinds of different ways why non-warrantable condo loans can be beneficial. If you ever run into a condo that you don't think there's financing for, we have a very big library of non-warrantable condo loans. So we can definitely go down that route. And that's a lot of times you'll see only cash buyers go into that because the terms are a little higher. You're probably in the fours, high fours to low sixes, and everywhere in between, depending on the product there.
Sean, you don't have a field for separate townhouses? Are you grouping condos and townhouses in the same?
No, townhouses are single family residences.
Okay, thank you.
So condos, the only difference between a condo and a townhome, other than the looks, is a condo, you don't own the dirt. You share wall space and airspace in the building, basically with a condo. So it's one entity, it's one organism. Whereas a townhouse is its own entity. Yes, there's an HOA, but you own the dirt. You typically don't share walls, but it's a true mortgage on a single family detached residence. That's how townhouses are looked at. So You do not have to go through the whole approval process like you do a condo on a true townhouse. Now, keep in mind, I would say 80% of townhouses out there, they're marketed as a townhouse is truly a condo. So you have to look at the legal description to see what it truly is. If it looks like a townhouse, it's even a separate building, it doesn't necessarily mean it's a townhouse. It may actually be a condo. So that gets people a lot. So we just need to make sure we're looking at the legal description when you're taking the listing to see what it truly is. Manufactured homes, not every lender does it. I would say about 10 to 15% of the lenders that are out there will do manufactured homes. Conventional and FHA only allow double wides. So keep that in mind, no single wides at all for conventional and FHA loans. VA allows it, but not FHA and conventional, only double wides. So you're going to see a lot of that. If you have a listing that's a single wide, there's a lot of frustration with buyers because they can't get that, but it's just the nature of the beast. Now, there are private mortgage companies that will do single wide loans, but they're 20% down or more portfolio, that non-qualified mortgage bucket. Also, they can never be moved. If you have a manufactured home that was moved from its original position, you have just put a you can never finance this again badge on it. Unfortunately,
I think that doesn't VA allow it?
VA sometimes.
That's what I thought.
Yeah, VA has a little bit of different. VA sometimes has it. It just depends on the year it was built, how it was moved. For the most part, I would say most lenders won't do it because the integrity of the building itself gets jeopardized when you move a manufactured home from its original position. We actually won't do that if it's moved on a VA, but there are a handful of people that may do it, but there's some very strict rules and regulations on it. Now, single wides are allowed on a VA loan, so that's one thing that's a benefit. I'll have to get you the exact guidelines for that, Valerie. So I can send those to you a little bit later today. Now, additions are not permitted. I'm sorry, additions that are not permitted are not allowed. So if you have an added garage that's attached to the actual building, it would need to be permitted in order to do a loan on it. So anytime there's an add-on, like an Arizona room was turned into an actual drywalled in and framed, but it doesn't have proper ventilation, or the AC is just like a window unit, but it was never permitted, or it wasn't done to code, that may need to be ripped out or not financed at all. So those can be a big problem with mobile homes. And you have to have power to it as well. So this is a relatively newer, it has to have power run to the lot. So a lot of these mobile homes that are completely off the grid, like totally off the grid, we're having a harder time with those nowadays. If they're solar, but they have power to the lot, then we're okay. If it's on its own well, or if it has hauled water, that's fine, but it has to have power to the lot now. Now, VA, a different animal. Again, Valerie, I'll send you those rules in regards to can never be moved. There are some very strict policies if it has been. Also, it has to be permanently affixed, and the same rules with the conventional FHA as far as permits. Lot loans. I get a lot of questions on lot loans. Lot loans are not a government-backed loan either. So they're usually only offered by banks. So we can broker to them, but we can never do them in-house because they're all products that belong to banks. So brokered, yes, I can do that. But between you and me, I would much rather them go directly to the source. It's a lot cheaper, and then they have an easier break to do from a lot loan to a construction loan if they started at the same spot. So construction loans and lot loans, I recommend going to banks for them, especially the local banks that know the area. They might know the lots that you're trying to build on, and the specifics regarding that, because there's a lot of draws that happen, there's inspections that happen, and trying to broker that is clunky. So I would much rather have the property have the overall experience be a wonderful one than me trying to do a clunky one through a brokered option through the lot loans and construction loans. So I want to talk a little bit more about these bridge loans that I do. these mini bridge loans. They're very popular this last 2 years. Anytime you guys are meeting with somebody that is going to be selling their home and then buying a new one, we really need to have a conversation up front to make sure that we can eliminate as many contingencies as possible. And one of the ways of doing that is eliminating the contingency to sell their property in order to buy the new one. So you can get a home equity line if the equity is there. You can get a home equity line on the house that they're going to be listing and use that as the down payment for the new house. So this is what I call the mini bridge. The old bridge loans that some of you out there that have heard of them in the past, because of the ability to repay laws that are out now, you have to qualify for all of the payments for all of the mortgages. So it can be very expensive because those are private loans now, and qualifying for them is difficult, and the rates are high, and it costs a couple points to get them. So this little mini bridge is a free way of doing it. So you take a home equity line on the house you're going to be listing, buy the new home, and follow me on this, buy the new home using the home equity line as the down payment, and we'll do like a 20% down or a 10% down, and then we'll get a loan on the new house. Now, once that house sells, that home equity line will be paid off, and then we can take the additional equity that was, or the cash received from the sale, and we can apply it towards the mortgage on the new house and do what's called a loan recast. And that's where we just lower the balance and lower the payments at the same time without refinancing the home. So that if you want to know more details on that, if you have people that are looking to buy, but they're selling right now and it's hard because there's a contingency, let's have that conversation to eliminate that contingency with this mini bridge program that we have.
Hey, Sean, I need to talk to you about this later. I have a client who might be perfect for.
Sure, absolutely. So when you look at it, we need to make sure when you're sitting down with somebody, I've run into this multiple times, not a lot, but multiple times where the listing agent has sold the house and then it's under contract and now they're getting pre-qualified to buy a new one. And guess what? They don't qualify. It's one of the worst positions you can ever be in as a customer that just sold their house and now has no place to call home, because you can't back out of the contract. There'd be a huge legal issue. It's a challenge. So I highly recommend, if you have somebody that's going to be selling their home and buying a new one, get them qualified up front for that second piece of the puzzle, for the buying side, because the last thing you want to do is sell their house and then they're not going to be able to qualify for the next one. I've seen it happen, and it's scary, and people, it's just hard. It's just really hard situation. So we don't want that ever to happen. So when you are selling the house, let's look at that first as part of the overall conversation that you're having when listing somebody's home. It makes you look really great too when in the listing presentation, if you bring that up, because it looks over their best interest, is trying to protect the whole experience. And then we want to know obviously what loan products are available for the property that you're going to be listing, so you can do that property in the MLS as far as what financing is available. I would say on condos and townhomes, a lot of times people just throw in FHA, VA, and conventional because it's within the right loan limit, but that might not be the case because of other items. So if you have any questions on what financing options are available for a particular property when listing one, give me a call. I'll be happy to walk you through that. All right, so I went pretty quick.
Is there a website or a source where we can, as we're going out on listings, and just check for condo complexes to see if they are or are not approved?
Yes, you can. And let me pull this up real fast. Hold on one second. I'm still showing my screen. I'm going to pull this up. So if you just do this, FHA approved condos, and Google that, the very first one is FHA approved condominiums HUD. You can click on that. Sorry, it's slow. And then you add in the state and the county. So let's just do this real fast. I'm going to do Arizona. I'm going to do Coconino. Here's all of the approved condos in Flagstaff area. Now this is expired, so you can go back to that list and tell you just give me the status of approved. and then hit send. Oh, sorry. How come it's not giving me any? I'm just going to give all, send. So there's not a lot. Look at this one's approved but expired. There's only 5 complexes in here, and all of them are rejected. So there you go. That's why it's hard to get condo financing in FHA loans in Flagstaff. Now you could get these reapproved. This one expired back in 2011, this one 2011, this one 2014. But this is where you can see. Now what you can do when you're searching for condos for an FHA buyer, you can go in here to the zip code. Let's do Maricopa. I'll just do it by zip code on here. I'll do 85255. And then I'll do just approved. If somebody comes to you, they say, I want to find condos, but I want to be in the zip code. I'm an FHA buyer. Go here first, hit send, and now you have there's 2 condos that are FHA approved in the whole zip code. So instead of going through every listing and trying to figure it out, go here first. It'll tell you which ones, and now you can look in those specific condominiums for listings.
Hey, Sean, how do they get reapproved?
You have to get the entire complex has to go through the approval process. You need a lender sponsorship to do so. So if you find yourself in a condominium complex that is that you wanted to farm, or you have done a lot of closings in and you've sold a lot of them, you may want to try to do this, partner up with a lender. It's a tedious process. The HOA has to be on board. If the HOA is on board, then we can get all of the documentation necessary and then submit that to HUD. So it's a process, but if the HOA is willing to do that, then lenders can do that. There used to be spot approvals. Those are not being granted right now. So it has to be the entire project. Now, the same is true for VA loans. So if you go VA approved condos, you'll see the condo report. And then here it is. Here's your search. You have to, it's easier to put the limited amount. So just do the state and the zip code or the city, and then submit. And now you have the VA approved condos. There's 11 of them. So that's the easiest way of doing that, or you can call me. But I would I would Google these 2 things. It's always the first one when you do VA approved condos and FHA approved condos. It's always the first answer. So that's, if you have any condos, that's the very first thing I would do. Second thing, I would look at the legal description. So easiest way is to go to the county website, pull up the deed, and look at the verbiage on the deed. If it says it's a horizontal property regime, then it's a condo. If it says condominium, then it's a condo. If it says lot number and it's an actual lot number, then it's not a condo. Believe it or not, there are properties that are labeled as like Biltmore condominiums, but they're truly townhomes. And then there's townhomes that are labeled as townhomes in the sales and all the names, but they're actually condos. So it's really important to look at that. All right, I am going to unshare my screen now and jump in here and answer any questions that you guys may have. Yeah, I'm going to copy these in here real fast, these VA approved, these links, so you guys can copy and paste. There's VA. And then I would save this as a favorite in your browser. That way you can always reference it, because it's nice to have it at your fingertips. I mean, you can always Google it, but this is a quick access here. Yes, credit unions, I believe that was in regards to home equity lines, right? Was that right, Clayton?
Yes, that's correct.
Yeah,
I did a couple with Arizona Federal Credit Union. So yeah, and they're more likely to do it if they also know there's a subsequent construction loan. So
yeah,
something to think about.
Absolutely. So there's a lot of, if you guys have any questions regarding any of that, just call me. I'll walk you through the different options and help you guys with that. But don't go too deep in the weeds. Don't try to know the guidelines or what is going to fit specifically, but just look at it with these different loan options, knowing kind of what you can and cannot do as an opportunity to see where you can help somebody. Like if you hear somebody says, you know, I really don't want mortgage insurance, so I'm going to save up for 20% down. You should say, no. There's ways of doing it without mortgage insurance. Talk to my lender. I can only qualify for an FHA loan because my credit score is a 580. Well, I have a credit boost program called FICO Boost. I can get the scores up for them. I didn't talk about it in this one, but that's something I'm going to go over in a lot more detail, maybe a little bit later, on how to boost credit scores. And but use me for that, so you guys can really help your customers that may have not thought they could purchase. And there's a lot of options out there. All of those grant programs are for FHA, VA, and conventional loans, not just FHA. So keep that in mind as well. And any questions? There's a lot of information on there, a lot of different loan products. I just want to make sure you guys knew what's available. Another one too, if you guys have anyone that has been turned down by a bank, guys, banks have terrible rules. Their rules are so much more strict than a mortgage company like ours. So if you ever hear of anyone not qualifying, send them my way for a second look, because you'd be surprised. I mean, I had somebody a couple days ago, I'm not sure what day it was, but I think it was last week sometime, saying they couldn't get qualified because they hadn't been in their job for 2 years. Now, they were a W-2 employee. They'd had a job previous to that, but they're only in the new job for like a month. It's a salary job. We don't even need a month on the job. We just need an offer letter to get them a job. I mean, to get them a loan. They can start a month later, and we can still do the loan based on their employment coming up. So there's a lot of rules that are out there that if a bank or somebody else says no, run it by me so that I can give you the true answer to what Fannie or Freddie will actually accept. Because most mortgage companies have overlays of risk that they create their own to kind of push away the higher risk loans. We do not have any of those. So make sure you know that. Anytime you run into somebody that's been declined, let me have a second look, because odds are I can probably help them.
Sean,
Or steer them in the right direction.
I have a question about that. What if the new job and they have an offer letter is a completely different field than what they were in before? Does that matter to you?
The field shouldn't matter. Okay. The pay structure does, and the job description does. VA is a little bit more sticky when it comes to switching jobs. If you have multiple jobs in a 2-year period, but let's just say you were a manager of a Staples, and then you got a new job as a manager of a restaurant. Now it's a salaried position, so it's the same type of role, but it's a completely different field. That would be fine. Or let's just say you sold insurance for 20 years, and now you work as a manager at an insurance company as salary, and you're only there for a day. We can use that salary. Or if you're self-employed for 20 years and now you get a new salary job and it's not even close to what you did, but because we show proof that you were professional for a long period of time, we can get that done. So the parts where you're going to have a trouble is I'm a W-2 person and now I'm sell insurance and I'm commission only. Well, that becomes a problem because commission, the hard rock bottom rule is we need 2 years worth of average commission if it's 100% commission to use that income. We can use the base income right away, but any commission or self-employed income usually is a 2-year tax returns, 2-year average. So that's where I would say if you switch careers, if you're doing to a W-2, it should not be a problem. If it's switching to like a commission only, that's where it could raise red flags. Or going from a W-2 salary to a self-employed, that's where it can be a problem. Good questions.
Good to know.
All right, well, if there's no question, I'll stay on for a little bit longer just in case you guys have some questions that you want to ask later. Rates are still good, and let's kind of see what happened while I was going here, see if they made any changes. A little bit better. They're down. Nope, it's exactly the same. Yep, exactly the same. So yeah, they're down 25 basis points for the day. So I locked mine today. What that means is the people that I locked this morning, they saved 0.125 discount points just by me knowing when to lock. So a lot of times when you're talking to buyers, they say, well, this bank over here is offering me this on a pre-qual. Well, the rates can change. A pre-qualification doesn't mean that's the rate they're going to get. A lot of people don't know that. And if they quote them that one rate and they don't know when to lock, they could lose that rate without even knowing. So having a lender that knows this behind the scenes to protect them is really important as well. All right. You guys are very welcome. And thank you for everything. Oh, if you guys have any topics that you're wanting to learn about, send them my way. Shoot me a text, shoot me an email, say, hey, can you talk to me a little bit about this or that? I'd love to bring that up and make it relevant for what's going on, what you guys see that's out there. So feel free to send those ideas my way.
Thank you, Sean.
You got it. You guys have a fantastic week, and hopefully rates will behave.
Give me a call when you're available, Sean. This is
Love you,
Valerie.
Valerie.
Thank
Yep.
you.
You got it. We'll
Bye-bye.
talk to you soon.
Thanks, Sean. See you, buddy.
Yeah, you got it, Clayton. Have a good one.
You too, man.